Deferred tax on FCTR, the position that's already there. FCTR builds every period. Exchange rates move, most controllers track it. Fewer have worked through the deferred tax position sitting alongside it. Where the temporary difference comes from. When you consolidate a foreign subsidiary, its net assets are retranslated at the closing rate every year. Your tax base, what the investment cost you, stays fixed. The gap between those two numbers is a taxable temporary difference. It exists in every group with a foreign subsidiary. You bought a USD subsidiary for 100 crore. 5 years later, the same net assets translate to 140 crore. Your tax base is still 100 crore. That 40 crore difference has a tax consequence when it unwinds. The exception and its limits. Ind AS 12, paragraph 39 allows you not to recognize a deferred tax liability, but only if two conditions are met. 1. The parent controls when the temporary difference reverses. 2. It is probable the difference will not reverse in the foreseeable future. Both, not one. Most teams apply this exception at setup and don't revisit it. That is fine, until something changes. When the exception falls away, the Para 39 exemption holds as long as both conditions hold. Triggering events could be many, including 1. A disposal of the subsidiary is being planned or decided. 2. A significant dilution of the parent's stake is under consideration. 3. A strategic decision to exit is communicated internally. When any of these occur, reversal of the temporary difference is no longer improbable. The Para 39 exemption can no longer be applied. Step 1. Recognize the DTL on the outside basis difference, FCTR component plus retained earnings component. Step 2. On actual disposal. FCTR recycles to P&L. Tax charge crystallizes in the disposal year. If the DTL was recognized before disposal, the charge is expected and already on the balance sheet. If it wasn't, it lands in full in the disposal year. The number that makes this manageable. The DTL assessment, whether to recognize how much and when, is judgment-driven and entity-specific, but the judgment is significantly impacted by one number, the FCTR balance tracked by entity across every period it existed. If that number isn't maintained, it gets rebuilt, usually under time pressure, usually mid-transaction. MyFinalyst tracks FCTR by entity across every reporting period. When a triggering event arrives, the cumulative FCTR balance is already there. Computed, not rebuilt. The decision to recognize the DTL and post the entry remains with the company. MyFinalyst ensures all the facts and numbers are in place when that call needs to be made.